Well, hello, and welcome back to the new episode of the Systematic Trading. Today I have a new guest, Kevin Maki. Why don't you introduce yourself and especially tell us a little bit about what you do and how you ended up doing the systematic trading?
Sure thing. So, I'm a scientist by training, and I've worked 30 plus years in pharmaceutical development, running clinical trials to test new drugs. But I struggled when I was in school deciding whether to go into finance or into a career in science.
Hmm.
I kind of ended up doing both. And so I was an entrepreneur, owned companies that were involved in clinical trials. And then on the side, I always was studying, investing, and trading.
Hmm.
And so I've been a serious student of investing and trading for about 40 years now. And so more recently have gotten much more into systematic trading, in part because I'm kind of winding down my scientific career, and that gives me more time available to do research and more activities related to trading.
Hmm. Okay, but obviously, systematic trading is basically what you do right now. But how did you start trading in general? 'Cause yes, you did some investing, but what was your actual story, the backstory? Because I'm sure
Sure.
that
Well,
people will want to learn how you ended up here, right?
yeah, so I had a path starting with value investing. So I started out as a value investor who was looking to buy companies below their intrinsic value, as I
Mm-hmm.
estimated it. And in the late 80s and early 90s, I started doing some momentum research. I read the Can Slim method by William
Mm-hmm.
O'Neill.
Yeah.
And so I started to look into relative strength as an investment factor. And so I was dabbling in that until about 2005. And so in 2005, I read Michael Covell's book on trend following.
Mm-hmm.
And that was focused on trend following and managed futures, but I was really interested in applying that to stocks. And so I started to combine trend models with momentum models. And that was really helpful because in stocks, trend or time series momentum is really helpful for reducing drawdowns. And then cross sectional momentum is really helpful for identifying those stocks that are really moving. And when you combine the two of them, you get kind of the best of both worlds with higher returns, but without the drawdowns that you can get with cross-sectional momentum, or much smaller drawdowns than I was seeing
Mm-hmm.
with cross-sectional momentum. So um, that was really helpful in that going into the great financial crisis in 2008, those trend models really helped minimize my drawdowns. And so what I would say now is that I've evolved into uh, kind of a two-sided investor. On one side of my portfolio would be quality and value methods, and that's about 50%.
Mm-hmm.
And the other 50% is momentum and trend models. And that doesn't include, or does include, some mean reversion, but I don't trade short-term mean reversion, more using mean reversion as part of a longer term uptrend. So I'm trying to buy dips in an uptrend and then hold for weeks to months, as opposed to
Mm-hmm.
short term mean reversion where you're holding for just a few days.
Mm-hmm.
So I'm a position trader. I trade in kind of slow motion. Um,
Mm-hmm.
on the models that I use for stocks and ETFs, my average hold time is about 160 days.
Mm-hmm.
And if you take out the small and mid cap models, it's over 200 days. So I'm not having a lot of activity, but I follow those models religiously.
Mm-hmm. But is there any challenges that you again? What I'm trying to understand is if I mean everything that sounds great, but it's after the fact because you took you a while to get where you are, right? So that's the interesting part. It's like, okay, so what kind of challenges you had? Did you not have the stop losses, or had some stop losses which were not really there? Especially for the position, kind of a value person. I'm sure you didn't have probably stop losses, but again, it's up to you what you were doing. So if you can explain a little
Yep.
bit more.
So when I was doing the traditional value investing, when stocks would go down, I would tend to buy more. And so, I put up with a lot of volatility and drawdowns. And then later on, when I got more involved with trend models,
Hmm.
uh, the big benefit of that was making my equity curve more stable. So it was more of a stable uptrend for the equity curve. And I did incorporate stop losses and different models with different time frames for entries and exit, with the idea of combining models that were not strongly correlated to give me a smoother equity curve, and then also incorporating other asset classes, so commodities and energy
Hmm.
stocks, for instance, to handle those periods where we have inflation. And there wasn't much inflation for a lot of the time that I was investing, but in 2021 and 2022, we saw a lot of inflation, and so those
Hmm.
that inflation protection I had in there with the commodities and the energy stocks was really helpful during that period.
So, I mean, what kind of then drawdowns did you encounter? Just again, curious, so people understand the sheer amount. Because I mean, some people freak out when it's a 5% drawdown. Some people freak out when only it's 50% drawdown. So, what type of
Yeah.
things did you
So
do see?
earlier in my investment career, I had some pretty big drawdowns, some of which were, 40% or so. And
Hmm.
those are pretty painful. And I was always good at following my plan. So when I would be in a drawdown, I'd be, investing more and buying more of those things that were going down. Later on, when I started to introduce the trend models, I was doing more rotation, so rotating out of things that were in a drawdown and into things that were in an uptrend.
Hmm.
And so my drawdowns diminished dramatically. And I don't think that over the last 15 or so years, since 2009, I don't think I've had a drawdown that's been more than about 12%.
Hmm. Like overall on
And
the total portfolio,
in the
right?
total, that's everything
Yeah.
together.
Hmm.
And so again, with different things that are zigging and zagging at different times, that's really been helpful for minimizing the drawdowns.
Hmm. So, how many strategies do you run right now simultaneously?
So on the momentum and trend side, I have 10 models, and it's really a little more than that because a couple of them I have different exit points. So I
Hmm.
may have one model, but with a couple of different exits for the models. So if you count those, it's about 15 models
Hmm.
on that side. And then the other side, it's partly discretionary, where I'm trying to buy things that are below my estimate of intrinsic value. And
Hmm.
partly I have some value models that are systematic as well.
Hmm. Okay. And one of the questions that I have is, okay, so on the downside, again, so you had some big drawdowns, especially earlier in your career, right? Especially in the trading. Right now, they're not as big, which is great, obviously. So it's much easier to deal with when they're down. But what about the upside? How big are your typical returns that you're getting with all your strategies combined? Because I mean, each strategy has its own unique place in this whole suite, but on overall, and how do you deal with the wins? Do you get a lot of euphoria, or it's kind of like a just a yet another day or yet another month or whatever it is? Like, how do you deal with that?
Sure. So since 2009, I've essentially kept up with the S&P 500, but with much lower drawdowns. So, like I said, not more than about 12%. And in 2022, as an example, which was a challenging year for
Hmm.
a lot, I think my peak drawdown in 2022 was about 7%. So I'm pretty happy with those results. We've had really spectacular market for U.S. stocks since that time, and I diversify across different markets: U.S., ex-U.S., emerging markets,
Hmm.
developed, etc. So I've been, very pleased with that. I've got some gold that I have in my portfolio all the time, but it's recently been really helping the returns as well. And what I would say is that combining all of these things has left me able to sleep well at night. And I'm not at a point in my life where I really need to make eye-popping returns. So at this point, if I just don't screw it up, I'll be in pretty good shape through the rest of my years and have some money for our kids and for some
Hmm.
charities that I'm interested in. So at this point, my objective is really to make decent returns and to keep the drawdowns acceptable. And then with regard to um, what I'm doing over time as I near retirement, I'm 60 years old, and so
Hmm.
I'm kind of in the tail end of my earning years, and I'll start living off of our investments fairly soon. And then I'll probably shift a little bit into some more income oriented strategies that throw off income automatically. Whereas now I pay very little attention. I actually try and minimize the income that is generated to minimize the tax
Hmm.
impact of the strategies we run.
Hmm. Okay. So, so right now again, for the past, what is it? You said from 2009, basically, right? Basically, you do a lot of systematic trading. But what made you to do the systematic trading? What made it as a switch for you instead of shooting from a hip, or instead of doing even the for the intrinsic value for your value kind of investing? What made you to switch to the systematic trading? Because there's got to be something that you
Yeah,
saw.
yeah, for me, it was academic studies. So, reading about the academic factor models and um, the approaches that are taken by, say, AQR as an example, which is a systematic shop that applies factor models. And so essentially, the more I read about those, the more interested I was in trying to do those on my own. And on the fundamental side, that's challenging. And so to get the data that you need, it's challenging. And to update all of the models as new fundamental information comes out, that's very time consuming. I
Hmm.
really didn't have enough time to devote to the upkeep that was needed to keep those models running. But on momentum and trend, that's based on price, and that information is readily available. And so I started to do more and more of my own research as I read the academic papers. Then I tried to see what they had done, see if I could replicate it, and then
Hmm.
beyond that, see if I could develop my own models. And so it was an evolution for me. Um, Again, starting with cross sectional momentum as the main factor that I was studying, to eventually moving into more trend and momentum and including some mean reversion and so forth.
Hmm. But do you have, just out of curiosity, because again, since you've been with us, right, for some time, but then it's been, when was it? Like 2022? I forgot even when you were with us.
Let's see. I think it was 2021 that I went to a course with Tom
Hmm.
Basso and Lauren Spensdorp in Miami.
Hmm.
Maybe it was 2022, but anyway,
Yeah.
shortly after that, I signed up and got Quantum X, and I'd been using other programs, and also I had some of the models that I was running. I was running in basically statistical analysis
Hmm.
software, so it has been a nice evolution to be able to test things a lot more easily than what I was doing previously.
Yeah, I mean, the reason why I'm asking you that, it's not about even the course. It's more about, like, that we usually have five different legs, especially lately. when you were in 2022, I don't think we'll call them that. Like, so the trend following, which is the long-term trend following type of system, that's exactly what you're doing, right? So your momentum trend following systems. Then we do have two types of mean reversions, which you're kind of not really fan of: the short-term mean reversion systems, so mean reversion shorts, mean reversion longs. But then now we do have three more legs. We have the panic hedge, we have the catastrophe hedge, and we have the inflation hedge. So out of these six, actually, because it's not five, it's six legs, in your current composition with your smaller drawdowns, you do have basically your long-term trend following approach, right? You said that you have some mean reversion, but they're, if you think about it, they're more of a trend following still. It just
Right.
you are hoping for the continuation of the trend, so it takes weeks and months sometimes to get there, right? So you do buy in the dip, but we still would probably categorize that as the long-term trend following, because the you is just trailing behind for this. Maybe you have a profit target, maybe you don't have a profit target, but it takes a while for you to get there. And mean reversion typically is a quick, you go to the profit target, you hit profit target, you're out, right? That's kind of like the feature of the mean reversion. So out of these six kind of legs, what do you use in your portfolio right now, other than the one that we already know, the long-term trend following?
Right. So as far as hedges, so I do have in some of the models I've developed myself using ETFs. So I've got hedging built into that a little bit with volatility, but mostly with rotation into um, the kinds of things that will tend to do well when equities are going down. Depending on what's happening in inflationary times, you'll have, as an example, energy stocks and
Mm-hmm.
commodities that will tend to do well. In deflationary periods, you'll have bonds that will tend to do well. And so I've got some systems that rotate based on the idea that you've got inflation that's higher, low, and going up or down. And then you've got economic growth, which is
Mm-hmm.
higher, low, and going up and down. And so rotating into assets that are going to do better based on which of those quadrants you're in.
Mm-hmm.
And so I do that sort of on my own, not as part of what I'm doing with Quantum X.
Mm-hmm.
And as I mentioned, some volatility, some VXX strategies that are in there as hedges. I don't really do any of the very short term things because I've done that. It was profitable, but it just didn't fit my personality. So
Mm-hmm.
I realized that I'm not really happy doing that. I'm more happy with the kinds of things that I'm trading maybe one or two transactions a week in
Mm-hmm.
all my models combined, as
Mm-hmm.
opposed to trade I'm going to be in for 4 days and get out. I just found that I didn't like doing that, and so I am able to manage some of the objectives in terms of minimizing drawdowns. Whereas my individual models may have 25 or 30% drawdowns, everything together
Mm-hmm.
has been much lower than that. And I should also mention that I have some managed futures strategies that I outsource to commodity trading advisors or via ETFs. And those go long and short. And so that's very helpful at times too. In 2022, especially, those were really helpful and offset some of the losses in other
Mm-hmm.
aspects of my portfolio.
Mm-hmm. Yeah. So that, I mean, yeah, that's the interesting, because like for me personally, I have close to 200 orders a day, like 140 orders a day. That's obviously I'm not entering the manual, right? It's
You're
all
doing it
automated.
automatically,
Yeah,
yeah.
yeah. So it's kind of a completely different situation. I have like 200 something positions at any given moment because I have so many different strategies. I mean, currently I'm standing at 67 at this as of now, because I've graded my portfolio. I usually upgrade yearly, so this is like before I had 59, now I have 67. So I accumulated over the year and updated. For you, it seems to be like you're on the opposite spectrum. You really want to have more slowdown, more steady state, less action kind of happening, right? Less hassle per se, so you can easily handle it without automation. Because if it's 1 or 2 trades a week with all your strategies, yes, obviously it's not that much. But the key question though, when you came up with these strategies, how, because that people always wondering, especially who know algo trading, how do you make sure? I mean, obviously, right now for you, it's time tested, so you know they are robust. They know they are not over optimized. But how did you come up with it not to be over optimized to begin with, and how you made them robust, what they are right now? What did you
Sure.
do
Well,
for that?
the starting point was always something where I had academic evidence from studies that this general approach would be effective. So that was part of it. And then it was a matter of developing strategies. And I did a lot of robustness testing for these strategies. So I'm very concerned about the potential for overfitting. So I do
Mm-hmm.
not want to come up with a strategy that's going to look great going backward and not so great going forward. And so I, tried to pick parameters, for instance, where they were in a zone of profitability. So
Mm-hmm.
not the best, but somewhere in a zone that was profitable. Then I did a lot of testing on, well, what if I pick the top 10? What if I pick the top 20? What if I leave out the first five and pick the next 15? What
Mm-hmm.
if I delay my entry by a few days or a week? How does that affect the outcome? What about exits? And what if I stagger my exits, for instance? So in some of my models, for instance, I'll have staggered exit where I'll go in to a full position and
Mm-hmm.
then I'll sell a third of it if it hits one exit, another third if it hits another, and the final third if it hits a third exit.
Mm-hmm.
And so then I would run Monte Carlo analyses. So, picking random order of trades and then resampling where you create a lot of portfolios with, sampling randomly from the trades that are in your back test to look at the distribution of compound annual growth rate and drawdowns to try and come up with something that looked pretty good. And I look at 90 and 95% confidence intervals for the win rate and then also the win loss ratio. And using all of that, I would come up with a set of strategies, but then on an ongoing basis, basically I try and check my strategies every 100 trades or so. And because my strategies don't move quickly, that's takes a while to get to 100 trades.
Mm-hmm.
And there I'm looking at the performance, out of sample from the back test. And I am saying, is this within a range that I would expect based on the back test? And another thing I should mention is I'll do a back test and then I'll try and test that out of sample over different time periods, different markets.
Mm-hmm.
And, if it is working really well on the S&P 500 but doesn't work at all on mid-cap stocks, for instance, that's going to make me a bit nervous. And I'm going to tend to pick something that works reasonably well in multiple markets that I tested on. So
Mm-hmm.
these are a whole series of things that I go through to come up with a set of models. And then once I'm running models, I've also found that some have not been a good fit to my personality. So I just stopped with the small cap models altogether. So now I stick with more mid cap and larger because the small cap, even though it was profitable, it was just generating too much activity.
Mm-hmm.
And I just didn't see enough additional performance for me to justify the activity. So now I kind of stick with mid cap and larger, and the small, I'm really not trading at all. As of last week, I stopped trading the small
Mm-hmm.
cap model.
So how often do you review your own strategies? Like which one you take out, or it's just ongoing, as you said?
It's ongoing, and if something isn't working well, I may turn it down while I monitor it.
Mhm.
And most of the time, you just wait a while and it comes back. But if it's starting to perform outside of what you would expect on the back test with a fairly large margin, then I'm going to turn it down a bit and wait. And usually it comes back once in a while. Over the years, I've had something that just didn't come back. And,
Mhm.
now I'm 3 and 4 years of really poor performance for a model. And then I may turn it off completely, still monitor it, but stop trading it.
Mhm. Okay. Okay. But again, in your case, as you said, even 100 trades it can take a while. If your average trade duration is like, what did you say, 100 and something days, right? Or
Yeah,
200 days?
160.
Yeah, 160 days. That's a long
Yeah,
time for one trade.
yeah. So
Yeah.
it takes a while, and for the most part, you know, I'm going. My assumption is going to be that if it worked well in the back test, and it worked in other markets and out of sample in time, that it's probably not broken. But once in a
Hmm.
while, something is really broken and doesn't, seem to work anymore for reasons I may or may not understand. And if that's the case, I'll turn it off. But that's been pretty rare.
Yeah. Yeah. I mean, similar for me. I still run a lot of strategies that I created back in 2020, and I'm still
Mhm.
running them right now. I if because they all have ups and downs and different market conditions create them. Like if you test it right now, you have the recency bias. So you look at the current action, and you may then say, "Hey, I will use that system right now." But if you move it in time, you may at some point in time say, well, you know what, it was such a bad system, I would not even include it. But even though it has its own place because it was propping your, as you said, non-correlation in play, right? If there's something non-correlated and was propping you in the other times, that sometimes I'm still sticking around with that system and will keep it in my portfolio just because you never know when it's going to come back up. Only when it's really underperforming for a while, then maybe I have some other strategies which are doing the same thing, so I can just replace them. Then I will replace them, but otherwise I will just keep it in my portfolio. And that's the reason again why I was asking about the robustness testing and about the optimization. So you don't have to optimize, because otherwise, if you did over optimize that, yes, you probably will churn a lot more systems in and out as you discover that they stopped working, because effectively you were just bypassing all the landmines, but now you are stepping on all the landmines. But if you actually did, in essence, a system or created a system which is a lot less optimized because it doesn't have a lot of parameters, the least the better, usually. And if you tried it as exactly what you said, like you remove the candidates from the list randomly, or in our case, we deliberately have the robustness testing where we call the jitter test, where I
Mhm.
throw in and update the historical data with random data, randomly changing the every time I run randomly changes the closing price for every single instrument. So this way you are deliberately throwing in disturbances into the data, so that if there was a landmine and you just barely missed it in your strategy, now you will step on it.
Now you step on
So
it. Yep.
yeah, so so that way the more I run, the more I will see if I'm stepping too often or not. So I will see where it kind of gravitates toward. It will gravitate towards certain compounded annual returns, or it will gravitate toward a certain level of the drawdowns, or it will work in or not work in a certain areas. And that's another way of how to again do the optimization. That's why we always try to come up with new ways to optimize and not optimize, robustness test
Robust. Yeah.
things. Yeah, to so that we're not over optimizing at all. So that's great. But any from all of that, because again, there are so many obviously probably life changing um, lessons that you've learned. So any changes like because you've been doing it for so long that I'm sure that the listeners listening to you may be wondering lots of things, but what did you learn from that? I mean, what are your life lessons?
Well, my life lessons are sort of four concepts, and This is really related to trend models, less so to mean reversion models. But my four concepts are trade with the trend, manage risk, because I think the
Mm-hmm.
biggest reason that people run into trouble is they overtrade. They trade too large. So what I tend to do is, add more systems rather than adding two winners, but
Mm-hmm.
manage your risk, and then also with regard to losers, when you're trading as opposed to long-term investing where you have to put up with some drawdowns in individual positions, when you're trading, cut the losers relatively quickly, not too quickly. And this is where the back testing is really helpful, because
Mm-hmm.
you can say, well, I'm not going to test a stop at 10%, 11%, 12%. I'm going to test 10, 15, 20, 25. And usually you get to a point, where there's a zone in there. And in that zone for your stop, you're going to find that as you widen, your win rate will tend to go up because you're not getting out of positions that are going to turn around as often.
Mm-hmm.
But if you get too wide, then it's not really a stop anymore. And so I'll just start over and say trade with the trend, manage your risk, cut losers quickly, and then let winners run. And one of the things I look at a lot is the distribution of my returns, because my returns with trend models are very right skewed.
Mm-hmm.
And so I look at, well, what if I take out the top 5% of winners? What then does my compound annual growth rate look like? And so I try to focus on systems that I'm going to be able to be in for a long time and not get out of things too quickly, so that occasionally when you get into a Tesla, for instance, it goes up, over 1,000% over a couple of years, that you stay in that trend. So,
Mm-hmm.
again, I'll just say that those four things for me have been kind of the
Mm-hmm.
guiding principles. So trade with the trend, manage your risk, cut losers, and let winners run. And that has, produced pretty uh, good results for me. And as I've evolved, because my evolution into trend and momentum started about 20 years ago now, and
Mm-hmm.
so even going through some things like the great financial crisis and COVID and 2022, it's performed well, or my strategies have performed well. So that leaves me feeling confident that they should continue to do so in the future, although
Mm-hmm.
the future can always be different from the past.
Yeah, and the interesting part is, I mean, that's why, as you said, it's your personality if you have the more trend following and the momentum type of systems, because they are the most reliable systems out there. They will repeat themselves over and over and over again. As an example, when I develop sometimes the S&P 500 system, because I have data all the way to 1950, I can
Mm-hmm.
test it all the way to 1950, and sometimes it's just incredible. You test the same system and it does exactly the same over and over decades and decades and decades of the data. And
Yeah,
that's again this out of sample testing, right? Because you, let's say you designed the system from 1995 till now, but then I open it up all the way to 1950 and then see what will happen.
yeah.
So
I do the same thing. I develop something in a certain amount of time, and what I may do is say I'm going to take this period of time, and it's maybe 20 years, and look at the parameters that performed well over that 20-year period. And then I'm going to go forward and backward from that 20-year period. And, if I'm going to use a system, I want it to be something that worked well, um, forward from when I developed it and back in time from when I developed it.
yep, yep, exactly. So any other topics you want to discuss that we didn't cover yet? Just again, so obviously don't want to bore people, but at the same time, I'm sure that the wisdom of somebody who's been trading for a long time. I mean, I personally have been trading only for almost 6 years now, So it's a different story for me versus you. Obviously, you've been trading a lot longer.
Well, one thing that I don't think gets enough attention is this idea of momentum quality. And the idea is that if you look at a stock and you say compare two stocks, one of which has a 25% return over the last year, and
Hmm.
another of which has the same 25% return but with a different path. What tends to be the case is the one that's had the slow, steady rise, sort of every month is going up a little bit. Those trends are the ones that tend to persist longer.
Hmm.
And so there's academic research showing this, and my own research has shown it as well, that if you use methods to not only pick on momentum, but quality of momentum, that will help you get into trades that will last longer and are actually more profitable on average than something that has the same level of momentum but has not had as smooth and steady a path. So you take something that's sort of flat for 4 months and then it jumps up by 25% and then it's
Hmm.
flat for another couple of months and then it jumps up again. That type of momentum does not tend to persist as long as the slow, steady ones. And the idea behind that is the boiling of the frog concept, which is that
Hmm.
if something jumps up a lot, people notice. But if you are gradually raising the temperature, the frog doesn't notice and it doesn't jump out of the pan. Well, other investors tend not to notice when something has a slow, steady rise. And
Hmm.
so as a result, the trend tends to persist longer. And so I've had really good success both with individual stocks, but also with indexes, based on ETFs of uh, doing ranking based on not only momentum but momentum quality, and then choosing the assets that have high momentum but that slow, steady pattern.
Hmm.
Because again, I like to be in a trade for a long time. My ideal trade is going to go on for years. And
Yeah.
so if I can identify something that's going up and just keeps going up month after month, that's ideal for me. But also, my back tests show that you get better returns doing that as well.
Yeah. But again, it's your personality because I think you started from the value investing,
I
and the
did.
value investing is literally based on that exact principle. You're trying to buy something which is undervalued, and you can hold on to it for as long as you still perceive a value in this stock, right? So it can be decades, and you can still hold on to that stock because if it has still value, has still room to grow, like why get rid of it, right? I'm not a value investor, so I'm not really doing that type of thing, but I feel like that you're kind of translating that personality into the even momentum in the long term following world as
Yeah.
well.
Yeah, no, that's true. And I'll mention one more thing about value buys. So I try and buy these long term compounders. And so I used to have this dilemma. I'd say, okay, now I think it's fully valued, or maybe it's slightly overvalued. Should I sell it? Should I sell part of it? What should I
Hmm.
do? Now I just put a stop behind it and I say, I'm just going to hold it until my stop is hit.
Hmm.
And once in a while, I'll have something that I bought in the value side of my portfolio and it's gone up a lot. I think it's fully valued or maybe overvalued. I put a trailing 20% stop on it. And lo and behold, that stop isn't hit for 2 years.
Hmm.
And so, that's been a lesson to me that when you think something doesn't have any more room to run, often it has a lot more room to run.
Yeah, because market can stay irrational longer than you can stay liquid, right?
Solvent, yeah.
Solvent, yeah. So it's the same exact expression. So why bother? I mean, if it continues to go up, hey, so be it. Maybe it's irrational, but you can capitalize on that
Yeah, the,
irrationality with the
the, the
market, right?
old expression is don't fight the tape, don't fight the Fed, and don't trust the crowd at extremes. Well,
Yeah.
things that are extreme can get more extreme over time, and it's often very surprising.
Which again speaks to the point why you have aversion to the mean reversion, which are short, because mean reversion is based on the extremes. You're trying to find the extreme low, let's say get in and immediately revert back. Or if it's shorting, you're trying to find the extreme height so you can revert back to the mean, right? That's like a true mean reversion, quick movement,
Right.
especially because again with your rationality of trying to stay for longer, try to cut the losses short, the fast basically. It's asymmetrical return, as you said. It's more right skewed. In mean reversion, it's neutral. It's actually, if you put the cone of the returns, it's kind of like here's the middle, and you have not right and left, right. It's in the middle. You have your as many losses as you have wins. Is just what you have is you sometimes you have more wins in terms of the number, right? And that's how
Yeah.
you win. But it's otherwise it's a win loss ratio. It's close to one. Versus in your case, in your win loss ratio can be like 10 sometimes, right?
Yeah, not, I mean, my average, I mean, occasionally it is
Yeah, occasionally,
10,
but yeah.
but my average, so I average about 50% winners, between 45 and 55,
Mm-hmm.
and 3 to 5 for my win loss ratio. So
Mm-hmm.
um, most of my systems end up, somewhere in that range. And, but of course, when you have a right skewed system, you occasionally have those stocks that instead of, you know, uh, going up, by 50 or 70 or 75% before your stop is hit, they end up going up, 1,000% before your
Mm-hmm.
stock is hit
Yeah.
or your stop is hit. And that doesn't happen often, but when it does happen, that's my favorite thing. I love to just
Yeah.
make money while I sleep. That's
Yeah.
just let
That
it
is
run.
true. That is true. So, I mean, again, just so we don't bore the audience too long, I think we can wrap it up for today. But it was great, a great discussion, a lot of interesting information. I think for people who are into the systematic trading, even if they're just beginning or whoever is already been doing it for quite a while, I'm sure they will probably find interesting information. So, thank you very much, Kevin, for coming in for this episode, and. Later on, I will see. Maybe we'll meet again and discuss how it progresses
Okay, well, that
further
sounds
down the
great.
road.
Thanks.
Yeah,
Thanks
yeah.
so much for inviting me, and it's been a great discussion.
Okay. Thanks, Kevin, and see you next time.
Okay, thanks.